We all know about the PPI scandal, not least from the cold calls most of us received promising to get our money back. But that was to do with personal accounts. What is less known is that many small businesses were affected by similar mis-selling, and for them it has been a disaster. Newsnight has discovered that rather than helping businesses affected, the Treasury put pressure on financial regulators to contain the compensation, which threatened to cost tens of billions of pounds. Now MPs have warned that business owners who've been ripped off once by mis-selling are in danger of being done over a second time. Andy Verity reports.
This is a story of how banks made thousands of business owners buy financial products they didn't understand, causing billions of pounds worth of financial damage and driving many firms into ruin. Then, when widespread mis-selling was uncovered, how banks made sure they didn't have to pay a giant compensation bill with the government's help. From this Worcestershire farm, Sebastian Parsons used to run a highly successful business called Elysia, the only UK distributor of Dr. Hauschka's ethical skincare products. Over 13 years, he and his two sisters grew sales from thousands to millions as celebrities from Madonna to Damon Albarn bought the oils and creams. But when they borrowed £3 million to buy this farm where their warehouse was based, HSBC spied an opportunity. The bank missold them a so-called interest rate hedging product, selling it as a form of insurance that would pay out if interest rates rose so they could manage their repayments. What wasn't as clear was if interest rates fell, as they did in 2009, it might be the business, not the bank, that had to cough up. Sebastian found himself paying £100,000 a year extra. Then the bank told Sebastian if he wanted to get out of it, he'd have to find nearly £500,000. Sebastian was shocked to learn that with that debt caused by mis-selling, he was in negative equity. The bank piled on the pressure.
I'm sitting in a meeting, being eyeballed by these guys who are extremely aggressive and hostile. There's a sort of clinical politeness about them. We were basically being told, sell our family home, sell everything we've got, risk losing the business, everything we'd worked for, because they had missold us a financial instrument that we didn't need, that we didn't want, and that we didn't ask for.
Sebastian's supplier, the maker of the creams, learned that the hedging product was draining company funds and terminated its contract. 40 jobs were lost, and Sebastian and his family lost their business. A forensic accountant found that but for the mis-selling, they would have made £7 million, known as a consequential loss. HSBC offered to pay back what Sebastian paid into the product, but put that consequential loss at just £27,000. It declined to comment on Sebastian's case, but says it's committed to fair compensation. In 2012, a study by the financial regulator found more than 90% of hedging products had been mis-sold and proposed a compensation scheme. The banks lobbied hard to minimise it. In January 2013, the Financial Conduct Authority drafted a compensation scheme which excluded thousands of the largest businesses, but that wasn't enough for the banks. I found out that when they were drawing up the compensation scheme, officials from the Treasury went to see the Financial Conduct Authority to press their concerns about how much it was going to cost. After that meeting and further lobbying from the banks, the regulator changed its scheme to exclude any business that had borrowed more than £10 million. That excluded over 5,000 businesses, saving the banks billions. The Treasury's official line is that it doesn't intervene or interfere with the independent regulator, but it doesn't dispute the facts. With the 2008 taxpayer bailout still fresh in civil servants' minds, no one at the Treasury wanted another giant bill.
My concern is that people who've been ripped off once might get ripped off again because of possible defects in the compensation scheme.
I found out that the Treasury put pressure on the regulator to contain the cost of the redress scheme for mis-selling. What do you make of that?
The Treasury has an understandable interest in trying to limit costs to the Exchequer, but Parliament has an interest in making sure that everybody, our constituents, are compensated for the right amount, no more and no less. Anything that was done that took us away from that principle, that compensation principle, would be unacceptable.
Independent experts say the cost of fully compensating all mis-selling victims would have been £30 billion. But instead, banks have set aside just £4.5 billion for the scheme. As of last week, only £1.9 billion had been paid out to business owners.
When you first hear this story, it sounds like it's just about businesses losing money. But actually, I spent months researching this, and I've spoken to dozens of ordinary people who feel they've lost their life savings, but also often their marriages, sometimes their health. They feel like they've had their lives taken away, that they've lost everything.
The Financial Conduct Authority admits the £10 million cap was put forward by the banks, but says it wasn't a concession to lobbying. It says compensation offers are checked by an independent reviewer, typically from the Big Four accountants. But if the business owners don't like the result, the reviewer isn't even expected to talk to them.
There's a concern that the agenda of reprivatising RBS and Lloyds overrode the importance of giving a just settlement to businesses who've been missold.
Well, it's not our agenda, so you'll have to talk to the Treasury if you want to understand that.
Well, you can reassure us. Did the Treasury intervene to make this scheme less expensive for the banks or not?
Our approach, we're independent of the Treasury. It's to do, as far as we can do, the right thing, which is aligned with our objectives.
They were copied into the emails?
Well, they have, as I say, a legitimate interest in knowing what the potential outcome could be, but not in trying to shape that outcome.
MPs have branded this scheme lacking in basic fairness and unacceptable. This is your scheme. Doesn't that bother you?
Yes, of course I'm worried that there is criticism of a scheme that has delivered redress for the vast majority of people and has achieved a payout of nearly £2 billion.
If the businesses try the only other course open to them, suing the banks, they'll face an army of highly paid lawyers. Many of them won't be able to afford to go to court. The banks know that. They've seen the accounts.